As the traditional equity markets open up for regular trading on this Monday, June 15, 2026, the current live intraday price for SoFi Technologies stands at 16.58, down slightly by 0.54% from the prior session. While a sub 1% intraday dip looks like standard white noise for a volatile retail favorite, the underlying technical chart reveals a massive divergence between institutional volume and public perception. Over the last several trading sessions, dark pool transaction data shows that larger financial institutions are absorbing shares right at this $16 baseline, even while retail forums are screaming about a massive correction from the recent highs. This stealthy accumulation is creating a coiled spring effect that completely escapes the average observer who only looks at the daily percentage change. The standard expectation surrounding this digital banking player is that it remains a hyper-volatile, rate-sensitive fintech experiment that cannot handle a persistently restrictive macroeconomic environment. Investors retreat this like standard online investing platforms, assume that when student loan refinancing demand slows down, the entire engine stalls out. The popular reality believed by the consensus is that traditional regional banks or larger brokerage operations will eventually squeeze out smaller apps because of funding costs. But the actual hidden reality is that the firm has quietly morphed into a highly profitable consumer banking powerhouse with net interest margins hovering near 6%, far outstripping the legacy financial sector. They are capturing the exact high-earning, tech-savvy demographic that older firms are losing, completely flipping the expectation of margin compression on its head. Looking closely at the recent stock movement, the trailing 6 months have been a brutal tug-of-war on Wall Street. The equity has slipped significantly from its 52-week highs, driven mostly by macro anxieties rather than corporate performance. When the organization posted its first quarter earnings report, the headline metrics showed that adjusted net revenues surged over 40% to cross the $1 million milestone for a single quarter, yet the stock dropped 12% on the day of the announcement. This dramatic drop happened because management uncharacteristically kept its full-year guidance steady rather than raising it, a move that sent algorithm-driven trading desks into a selling frenzy. This gap between staggering operational execution and a punishing market reaction is exactly where individual self-investing strategies get tested, because the tape shows heavy institutional blocks changing hands while individual brokerage accounts panic sell during these engineered dips. Trading volumes have spiked noticeably during these down days, which typically points to heavy distribution, but subsequent recovery sessions reveal an immediate drying up of sell orders. This behavior means the liquid supply of free-floating shares is getting locked up by long-horizon funds. The broader consumer finance sector has been under immense pressure as Treasury yields remain sticky, which naturally increases deposit competition across the entire banking ecosystem. When you look at competing digital ecosystems, the pressure is visible everywhere. However, the unique advantage here is that the customer acquisition machine has not slowed down, bringing in over 1 million new members in the opening 3 months of the year alone. Institutional activity reflects this resilience, with major asset managers steadily increasing their positions in core financial technology exchange-traded funds that hold significant weight in this name. To really understand how we arrived at this $16 crossroads, we have to look at the foundational architecture of the business model. The company operates as a fully integrated digital financial service platform, having secured a traditional bank charter years ago that allowed it to stop relying entirely on third-party banks to fund its lending operations. This structural shift changed the game because it allowed them to use low-cost member deposits to clear their high-yield personal and student loans, completely altering their net interest income profile. Alongside the consumer banking division, they operate a technology platform segment through acquisitions like Galileo and Technisys, which acts as the back-end infrastructure for other fintech platforms worldwide. Although this technology segment suffered a temporary revenue dip due to the loss of a major client, it creates a diversified B2B revenue stream that insulates the core business from pure consumer credit risk. Historically, older financial reports reveal that the business was heavily weighted towards student loan originations, a dependency that severely punished the equity when federal repayment freezes hit years back. The pivot towards personal lending and wealth management products was born out of necessity, but it ultimately built a much sturdier balance sheet. Comment below how many shares of SoFi stock you currently hold, or if you are waiting for a deeper dip before buying in. This shift from a niche student loan refinancer to an all-in-one financial dashboard directly mirrors the secular trend towards consolidated online investment and comprehensive banking apps. By offering everything from checking accounts with premium interest rates to self-investing options and automated wealth management, they keep users locked inside their ecosystem, dropping their customer acquisition costs over time. When comparing this platform to the broader market of investing sites, the competition is fierce but distinct. Traditional players like Fidelity Investments offer a massive moat through legacy Fidelity mutual funds, robust Fidelity brokerage services, established Fidelity wealth management structures, and millions of corporate Fidelity IRAs tied to retirement plans.
Newer retail investors often look at the sleek Fidelity mobile app or the advanced Fidelity trading platform and find everything they need, particularly when exploring diversified Fidelity ETFs. Similarly, options like the Schwab Intelligent Portfolios provide a highly automated corporate-backed framework for hands-off wealth accumulation, proving that the corporate giants are not sitting idle while tech companies try to take their market share. The landscape is crowded with alternatives where users can invest online, but many of these older institutions lack the native cross-product reward structure that binds a digital-first banking user to their credit, loan, and investment accounts simultaneously. On the other hand, the purely mobile-first brokerage races present a different kind of rivalry. The massive footprint of Robinhood stock trading remains a magnet for active retail traders who live inside the Robinhood app to manage their Robinhood investments and growing Robinhood crypto allocations. Features like Robinhood Cash Management and the widespread adoption of Robinhood fractional shares have made capital markets incredibly accessible, driving high engagement on modern investing sites. Yet where those models lean heavily on transaction volumes and premium retail subscriptions, the strategy we are analyzing leans on turning that trading user into a primary banking depositor. It is a direct fight for wallet share against traditional individual brokerage platforms, where the ultimate goal is not just providing an interactive brokerage platform with low interactive broker's fees, but rather owning the user's entire paycheck. For the high-net-worth individual or the multi-currency institutional trader, options like interactive broker stock trading or a specialized interactive broker's account remain the gold standard due to unparalleled global market access and sophisticated interactive broker's trading tools. But for the ascending mass affluent professional, the value proposition of a single app that automates wealth, manages high-yield savings, and refinancing debt is a massive draw. The platform's active investing features, proprietary exchange-traded funds, and integrated robo-advisor options are designed to capture that exact mid-market segment that feels alienated by the institutional coldness of an advanced interactive broker's platform, but wants more comprehensive banking utility than a standard trading app provides. Looking forward, the future outlook for the company relies entirely on the tension between conservative management guidance and accelerating underlying profitability. The ultimate opportunity lies in the rapid scaling of their loan platform business, an asset-light model where they originate loans and pass them directly to institutional partners who have committed billions in capital. This setup allows them to generate lucrative fee-based income without expanding their own balance sheet or risking their own capital, providing a clear path to return on equity expansion. If the technology platform segment manages to secure a few marquee enterprise banking clients in the latter half of the year, it will trigger an immediate upward re-rating of the stock, as Wall Street will once again price it as a high-margin software business rather than a traditional regional lender. However, the catalysts are balanced by clear structural risks that keep the bears firmly entrenched. Persistently high interest rates could eventually pressure consumer credit quality across the broader retail landscape, leading to an uptick in loan delinquencies that would force the bank to increase its credit loss provisions. If deposit competition intensifies further, the cost of retaining those sticky consumer deposits could rise faster than loan yields, compressing net interest margins and taking a bite out of bottom-line profitability. Furthermore, if the broader economic backdrop weakens significantly, consumer loan demand could dry up entirely, leaving the company with expensive deposits and fewer high-yielding places to deploy that capital. To sum everything up, the central insights surrounding this digital financial giant show a business that is completely disconnected from its current market price. The prevailing expectation is that the stock is a risky, struggling fintech entity caught in a hostile macro environment where it cannot sustain its valuation. The reality is that the firm has structurally evolved into a highly profitable, self-funding banking institution that is consistently printing record-high adjusted earnings before interest, taxes, depreciation, and amortization, while simultaneously doubling its net income. The temporary setback in its technology platform and the conservative choice to hold full-year guidance steady have masked an incredibly strong customer capture engine. For investors navigating the landscape of online investing, this creates a massive divergence where the market is pricing in a structural deterioration that the actual financial metrics flatly contradict, leaving an asset producing massive cash flow trading at a profound discount to its future earnings power.